Hi, I'm Gene Trowbridge, and you're listening to the Passive Investor Show.
Before we continue with the show, I want to provide the PI listeners with an opportunity. Like me, you probably invested in the stock market and found out that you could do better with real estate. You probably have invested in real estate yourself and found out that you created another job. You're already busy making a living to provide for you and your family. You don't need another job managing tenants and organizing repairs. What if there was another way? What if there was a way for you to benefit from real estate without having the burden to be the landlord? At the Fortes Company, we partner with investors like you and provide opportunities that are specific to your investment criteria. We operate the investment and you enjoy the benefits of passive income and everything that comes along with real estate. You deserve to keep your spare time and continue to make memories with your family. Go to www.investwithfortes.com and see how easy it is to become a passive investor today. The views and opinions provided on this show are for informational purposes only and should not be misinterpreted as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, please go to passiveinvestorshow.com.
Are you a busy professional looking to diversify your portfolio? Ever wanted to passively invest in real estate but don't know where to start? John Fortes provides you with a guide to passively invest in real estate. This is the Passive Investor Show.
And now, the Passive Investor Show. Here's your host, John Fortes.
Welcome, PI listeners, to the Passive Investor Show. I'm John Fortes. Our goal and purpose of this show is to be a resource to passive investors to help them master their investments in real estate funds. I have an awesome guest today, Gene Trowbridge. He's the founding partner of Trowbridge Law Group, LLP. Gene's law practice concentrates on the syndication of commercial and investment real estate through both debt and equity. Gene has represented over 500 clients in this area of practice. The medium offering size is $2 million, but he has done individual offerings of over $5 billion. His practice writes offerings under Rule 506B and 506C of Regulation D. As a former syndicator himself, who for 10 years raised investor capital through the broker-dealer community, he is able to communicate with his clients on both the technical and practical aspects of state and federal securities law. As a longtime CCIM and CCIM senior instructor, Gene has won numerous awards for his teaching ability. His book, It's a Whole New Business, is really a how-to manual on real estate syndication. We're welcome to have you, Gene.
Well, thanks, John. Pleasure to be with you. It's early in California. I'm having my first cup of coffee and enjoying it.
Salud. Enjoy that. Tell us a little bit more about your background and how you did all of that. That's pretty cool.
Well, first of all, you have to live a lot of years to do all of that, John. And so I've done that. I came out of college and went into commercial real estate, and then just by accident got into really the syndication business with some friends of mine. We bought a little apartment building, and I kind of liked that. And that moved me into the syndication business for about 15 to 20 years. And then I had enough of that. The care and maintenance of partners. I know this is a passive investor show, but let me say that again. The care and maintenance of passive investors can wear you out. Okay. So I went to law school at 45 so I could be an attorney and take my practical experience and then help mentor other people who wanted to be syndicators, stay in the securities world. And so I've been doing that now for 27 years on my own and with a couple different partnerships and back now to reestablishing kind of my own game, Trowbridge Law Group, and I think this is where I'll be until I drop the shovel for the last time.
I love how you pivoted at 45 after you explored one career and you dove into another. Can you go back and start telling us how you started working with passive investors?
Okay, oh gosh, it was a while ago. I was selling commercial real estate, and I ran into an apartment house. I was living in St. Paul at the time. Ran into an apartment house that took more money than I had on my own to buy, and called three guys I'd gone to college with, who all now were working on our careers. We all owned our house. We had our life insurance, and hopefully we had a little money to invest. And I know we each put $10,000 down, and with our $40,000 down payment, bought a $120,000 10-unit apartment building in St. Paul. And that's how you get into syndication. You don't have enough money to buy all the real estate you want to own yourself, so you have to pool money from other people. Now, that's the viewpoint from the syndicator. From the passive investor side, which we all were at that time, we didn't have enough money to go out and buy something ourselves. My three partners really didn't have the real estate expertise. They didn't have the time for management. So they were really looking for a passive investor or passive investment opportunity. And that's kind of how it all started. And so I found that my skills, my ability to put deals together was of value. And there are a lot of people out there who would like to invest passively. And now today, John, I work for some groups, or inside of some groups that you're kind of aware of. And some of these people call me and they say, Gene, I've been a passive investor in 23 deals, and now I want to be a lead. I want to be the syndicator. And my first question is, why? Why would you want to do that? Aren't you doing well as a passive investor? And they're all saying, oh, yeah, I'm doing really well, but boy, I want to make all the big bucks that the syndicator makes. And I said, have you thought about the risk? Well, no. Well, let's talk about that. So that's where we go, John.
I love how you angled that, because I wanted to fast forward to where you are now, and let's talk about those risks. Is there a place you want to typically start where you would start with a passive investor coming to you and say, I want to be the lead on a...
Oh, well, yes. The problem with being a lead is it really takes you out of the real estate business. You know, my book is called It's a Whole New Business for a reason, because as a syndicator and as a lead, what your job is to manage money of other people. You put together a deal, you have 20, it's not unusual to have 20 or 30 investors in a deal. Now you've got 20 or 30 brand new best friends, and they're demanding. They should be demanding. You have your money. You have a fiduciary duty to them. You can find someone to manage the property. You can find someone to help you in the acquisition field of real estate, but no one can take your place when you're managing the investors. So I find that's the biggest thing that they don't understand. And why is that a risk? Well, if you take 20 or 30 investors and put them in a deal that lasts for 5 or 7 years, things happen. I mean, we're in the middle of things happening right now, right? When you put this deal together 5 years ago, did you think you'd be owning it through this virus pandemic? You know, when you put a deal together 4 years ago, did you know that your lead investor, your number one investor, would file bankruptcy or have a divorce or get sick or die, and their people come to you and they want their money back? Did you think about that? No. You have to have been in that place a number of times to understand that the risk is more with the people than it is with the real estate.
I love that. And what is their number one pushback against that when you're going over these risks? When someone wants to become a lead and you as an attorney, how are you advising them?
Well, I just try to spell it out and give them my practical experience. And what do they say? No, I still want to do that. Okay, fine. Thanks for listening to me. I've given you my advice. Now let's go and put it together the best way we can so that you're protected and your passives are protected. Because that's really one of the things I'm supposed to do when I draft these documents.
Absolutely.
Is put a set of rules together that protect the passives and their money. The securities laws are all designed to protect the investors in what they buy and from whom they buy it. That's what the laws are all about.
Absolutely. So let's jump into the 506Bs and the 506Cs. Now, typically when someone's a lead or brand new to the industry, what would you instruct them to do? Which avenue, 506B or 506?
I think we need to go back. We need to go back one step, John. I'm sorry, I didn't mean to interrupt you.
Go ahead.
We need to talk about why do you even care about 506B and 506B?
Absolutely.
And the reason for that is when you put together a group of investors, you take their money and you manage the project, you've created a security. We're not talking real estate anymore. We're talking about this whole new world of business, the securities laws. And the securities laws have a bunch of facets to them. And one of the facets is we want to protect those investors who need protection. So in the whole world of investors, there may be a chunk of investors who don't need as much protection. So they came up with Regulation D, which is a carve-out of the full securities law designed to let people do private placements with people who are rich and smart and can read the documents themselves, make their own decisions, and take their own risks. So that's where Regulation D comes in. And in the last 12 months of numbers that the SEC put out, Regulation D was responsible for raising $1.8 trillion with the T, $1 trillion, John. That's more money than was raised in that period of time on the New York Stock Exchange. And where does that money go? It all goes to small businesses. This is capital formation for small businesses. Now, certainly, all of that money isn't going into real estate, but a lot of it does go into real estate. And in Regulation D, today, as we're talking, there's Rule 506, which is a rule that allows you to raise money from rich and smart people. And that has two parts to it, B and C. Okay. So 506B says, you can raise as much money as you want from as many rich and smart people as you can find, and 35 people maximum who aren't rich and smart, as long as you don't advertise. 506B. And one of these moments, you're going to ask me what rich and smart is, but let's leave that alone right now. And let's go over to what happened in the Jobs Act. The Jobs Act 2012 came along and said, we're raising all this money and we need all this money for small business, but what could we do to promote capital formation? How can Gene Trowbridge's syndicator get to meet more rich and smart people? And how can more rich and smart people get to know Gene Trowbridge better than the way we're doing it today? And they said, well, let's let Gene advertise. Gene can advertise to everyone, but we're going to put some restrictions on him. He can only raise money from rich and smart people because chances are he's going to be raising money from people he doesn't know. Over here in B, no advertising. More than likely, well, Gene and the investors better know each other. So there's some relationship going on. But over here, maybe you're looking for investors off of your Facebook page, and you're thinking someone you don't know is just going to send you a check. Well, we kind of have to protect those people too. So in C, if you're raising money from a rich and smart person, you have to have some third-party verification that they are rich and smart. You can raise as much money as you want from as many of those people as you can find. However, that $1.8 trillion, 93% of that money is still raised over here. No advertising, 506B, because most syndicators want to deal with people they know. They think there's a mystique about taking new investors in that they don't know. And all the experienced syndicators, John, have plenty of investors. The investors they have, plus the referrals they get from those investors, that's all they really need. Sometimes I see new investors going to 506C so they can advertise and build their database. Was that good enough?
That was awesome. And thank you for rewinding me back to Regulation D. I love that. Appreciate that. Now, let's talk about, and you said it already, what is rich and smart? Who are the rich and smart?
You and me, we're looking at them, right? Everyone's looking at us. No, wouldn't that be great? So by definition, and it's crazy, it's a definition that was written in 1981, John, and it said rich and smart. Well, before that, you could raise money, but they wanted you to raise money from people who they said were accredited, but there was no specific definition. So in 81, Reg D was changed a little bit, and the definition of accredited was written in the code. And the definition is that an individual or a family that has $1 million of net worth. Dodd-Frank came along a little later and said, don't count your personal residence, don't count your primary residence. $1 million of net worth other than your house, you're rich. You probably are smart because you got there. If you can't meet that definition, there's another definition you can go by, and that's based on earnings. If you're an individual taxpayer and your earnings are $200,000 a year, and that's kind of regular, you're rich and smart, you're accredited. If you're married, filing jointly, and the household income is $300,000, your household is rich and smart and you're accredited. So those are the rules, and those have been the rules for a very long time. I mean, in 1981, $1 million was something, right? So they have never changed that set of rules. But right now, as we speak, John, the SEC has some proposals out there for comments that might expand the definition of accredited. And without going into the specifics, what they're really looking at is they're looking at certain people who in their job advise accredited investors in what to do. Financial planners, stockbrokers, registered investment advisors. If they're actually in the business of working with accredited investors, maybe they're probably educated, maybe we'll just call them accredited. And things like family offices. Family offices are often interesting because a family office may have minors as members with no income. Who knows? And senior citizens, who knows? So I think that they'd like to go to a group like a family office that's been in existence that has a net worth of $5 million. And they might like to say, well, that's an investor, and that investor is accredited. So I'm looking for some resolution to this by the end of this calendar year, and we should see some expansion of that definition. And why? It's all about capital formation. And by God, right now, we're going to be in a position where a lot of people are going to think we need to raise more capital to help small businesses move on. And that $1.8 trillion I've talked about 3 or 4 times, about 90% of that goes to small businesses that employ less than 500 people. So that's the economy. So I think it's extremely important today that they do increase the definition or expand the definition of accredited investors.
I love that breakdown. Thank you for explaining that. Can we transition in why it's so important to have these protected documents when going into a syndication?
Sure. In my business, I draft the documents. A syndicator, a lead will come to me. I'm going to do a deal. Gene, will you draft the documents? I draft the documents, and I have a couple purposes. The first purpose belongs to what we call the private placement memorandum, the PPM. And the private placement memorandum in my world is the story. I need to interview the syndicator. I need to find out what's going on. What about the property? What about the syndicator? And then I write the story. I run it by the syndicator to have the story right. That's great, because that's where the passive investors learn what the business plan, what the strategy is, what the biography is of the syndicator. That's all plain English. How's the money going to be spent? All written in plain English. But now that we have the story, now I have to go out and write a document, which is the legal document that sets the rules. PPM is not a legal document, it's just disclosure. But the operating agreement or the limited partnership agreement, depending upon what entity you're using, is the set of rules. Who can sign, who can do what, how do you vote, what about liquidity, what about disputes, what about financing, what's the authority of the members, what's the authority of the manager. So that's a set of rules, and that needs to be done correctly so that everyone is protected. Everyone is protected from that document. And then there's the subscription agreement, which is the third document, which is basically the passive investors making an offer to invest with the syndicator and supporting that offer by filling out the offering questionnaire, which gives the syndicator information about the investor so that the syndicator can make a determination on whether the investor is really suitable to be in their group. So the documents are important for the syndicator, kind of puts handcuffs on the syndicator. The operating agreement tells the syndicator what they can do. The operating agreement tells the investors what's going to happen, and are there remedies for anything that goes wrong? Are there solutions for things that go wrong? And that's my responsibility to make sure those documents are good.
Awesome. Gene, is there a set of questions passive investors should ask syndicators?
There is, and I'm really glad you asked that. When I go through these four, I'm going to give you four questions. When I go through these four, I'm going to address the passives. But anyone who wants to be a syndicator should listen, because they're the ones who have to answer these questions, right? And you'd be surprised how little these questions have to do with real estate. And that's what we're talking about here, is investing in real estate, right? Number one question. John, you've got this offering. I've read all your documents. Everything is fine. It sounds like a good story. It's the dollar amount I'd be willing to invest. But my question to you, John, is if I give you the minimum investment that you want, what happens if something happens to you? You better have an answer, John. That's a continuity question. And believe me, things happen to syndicators. And it's not just that they die. I've had divorces, lawsuits, bankruptcies, medical conditions, and a few deaths here and there, where if we hadn't had continuity, meaning 2, 3 people, some sort of an entity that exists past the capability of the lead of running everything, all the investors are in trouble. So you've got to be able to answer that question. Does that sound like a question you might have heard before, John?
Absolutely. You have to have that
That's the number one question, John.
You got to have that.
I don't, as a habit, and I don't do it for business, look at other people's documents. I'll have passives who will call me and say, I want to invest over here. Will you look at the documents? I don't do that. But I will tell the investor to look at one part of the document. Who's the syndicator? Who's the lead? Who's the manager? If it's an individual, even if it's one person inside of an LLC, go find another deal to invest in, because that's extremely risky for your money. Okay, number one question. Number two question they ask, John, I like all this. John, have you done this before? Okay, so that's a track record question, right?
Sorry, I'm on mute as you're talking. So
oh, I'm sorry. John, have you done this before? Well, that may very well be the answer that every one of us have ever had to give to start out with. And that answer is no, this is my first deal. Well, that's okay. For some investors, it isn't. But for many investors who are talking to you and know you anyhow, they might know it's your first deal, but they might know that you have experience in real estate through your own investments, your education, what you know. And so you can get by that by having some answer. If the answer is no, you've got to have some other answer. I've got a partner who has experience. Okay, that's a good one. And so you've got to, as a syndicator, you've got to get by that question. You've got to get your first deal done. Don't try to raise $50 million on your first deal. Do a small deal, get it done, so that when Gene asks you, John, have you done this before? You can say, hell yes, once. Good enough. Good enough start. Third question, John. If this is such a red hot deal, John, are you investing any of your own money in it? What do we call that? Skin in the game? Now, once again, that's not a knockout if John says no, because John might just be personally signing a $2 million loan. That might be enough investment from John. But generally, the syndicator puts some money in the deal. We write a lot of deals today where the minimum investment is either $50,000 or $100,000. And if you're doing a lot of syndications, you can't invest that much in every single deal. So maybe the market will accept that you're putting $25,000 in this deal. Who knows? That's kind of a marketing question. And then the last question is, John, if something happens to me, is there any way I'm going to be able to get my money out of this before we have to sell the property? And so that's a liquidity question. That's from the passive investor side. And so what John is going to say is, sure, we have a well-drafted operating agreement with all the rules. And if you read Article 11, we would talk about the liquidity provisions that apply to the investors, the passives, and you'll see that there is a great plan there in case something happens. You'll notice in those 4 questions, I didn't say what's the cap rate, what's the cash on cash, what's the interest rate on the loan. That's okay, and that's something you're going to study. But these are 4 basic questions that an investor should ask before they consider handing you the check, John.
Gene, I love those questions. It's about vetting the sponsor. And at the same time, LP's got to understand that the sponsor is vetting them as well. So, Gene, I love that. That's the 4 questions LP should be asking, passive investors should be asking. Now, I know you gave us a lot. Is there one more nugget? Is there one more piece of advice for the PI listeners?
Okay, for the passive investor listeners, I think what you need to do as a passive investor, and once again, you syndicators should listen to this. You need to decide what economic benefits you need from your investment. Are you investing to build your net worth? And you don't need quarterly checks to buy groceries. Are you investing to get quarterly checks to buy groceries and you don't need net worth? Well, those are two different types of offerings that are out there. Okay? You need to decide what the economic benefits are that you need, and then you need to look at offerings and see, well, is this the type of offering? Is this the type of real estate and the section of the life cycle phase of this real estate that's going to give me what I need? And syndicators need the same thing. You need to decide who your market's going to be and what economic benefits are they looking for. When I got really mature as a syndicator, John, I was raising money from people who wanted to build net worth and weren't interested in current cash flow. We were building storage facilities. We were managing them until they got 50, 60% occupied, and then selling them to the long-term owner. My investors wanted in 2 or 3 years to get a certain percentage increase in their net worth, and I didn't have to worry about checks. But if my group of investors had been retired school teachers, they never would have bought into those deals. I would have had to have been the person who bought the 50, 60% occupied storage facility and then ran it for a long time and generated checks that I could send out. So I think a syndicator has got to do one or two things. You've got to be a product syndicator, meaning I know more about self-storage than anyone in the world, and I know more about building self-storage. So now I need to go out and find people who want the economic benefits of self-storage and that phase in the life cycle of a self-storage project. That's important.
I love that, Gene.
Or you're a social syndicator and you know that all your money is coming from retired school teachers. Now go find something that produces a quarterly cash flow and you're on your way.
Thank you for sharing that up. I appreciate that. Gene, I know all of these questions have been super easy for you. I have the hardest question of the night. How can we stay in touch with you?
Okay, well, that's pretty simple. I'm a recognized name in the industry, so you can call me. Anyone who wants can just call and talk to me, 949-855-8399. And I'm in California, so think about that in case you want to call me before I have my first cup of coffee. Or you can send me an email directly, Gene, Gene, at GeneTrowbridge.com. That'll work. And don't hesitate to go to our webpage. Our webpage is TrowbridgeLawGroup.com.
Thank you, guys. I know that Gene's law firm, they put out a lot of content to educate people. So I utilize it. I go there frequently. I do find out the best ways to practice and better share up my business. So please be sure to go get his book. It's a whole new business. And Gene, thank you for coming on. I really appreciate you.
You're welcome. It's a pleasure. Stay safe, and we'll see you on the road, John.
Appreciate that. PI listeners, thank you for listening. As always, we hope this was the best resource for your investment strategy, but also the best use of your time. As much as it pains us to leave you, but you know what time it is. Time to go put this into practice. Till we meet the next time. Happy investing. PI listeners, I'm grateful for your time and I appreciate you for listening. It would mean the world to me if you went to iTunes and left a rating and written review. Let me know how you feel about the show. It really makes a big difference with getting the podcast out there. Don't forget about our Facebook group, where all of our guests are members of. I'll be there to answer any of your questions or even questions you might have for future guests. Subscribe so you can get the latest episodes and our fan favorite quick hitters. Finally, I want to keep you updated, so head over to johnfortes.com and sign up for the newsletter. If you're interested in partnering with me, sign up on the contact page so you can talk to me directly. I look forward to connecting with you. Happy investing.